Look at your bank account on the second Wednesday of the month. You're expecting your Social Security check to cover your bills, but hundreds of dollars are just gone. Evaporated. Poof. No letter in the mail, no warning from your bank, no red flags. Just a drastically reduced number staring back at you, throwing your entire retirement budget into an absolute tailspin. If you think this is some weird banking glitch, let me be real with you. It's not. What you're looking at is a highly engineered, perfectly legal wealth extraction machine. And here is the crazy part. It is quietly activating for millions of Americans right now, today, in 2026. Welcome back to the channel, guys. Today, I'm going to expose the absolute most vicious financial trap the federal government has ever built to legally drain retirees. Why should you stick around until the very end? Because this trap starts with one single innocent financial move you probably made 2 years ago, thinking you were being incredibly smart. But wait, how does a smart move ruin you? Because that one move triggers a catastrophic chain reaction. We are talking skyrocketing Medicare fees, forced IRA withdrawals, and an unforgiving tax penalty loop. It's so brutal that Wall Street accountants literally refer to it behind closed doors as the death spiral. Sound like a bad financial horror movie? It gets worse. Listen to me very carefully. The government operates on a 2-year look-back lag. That means whatever you did back in 2024 is literally being weaponized against you right now in 2026. We'll get to the absolute worst part in a second, but by the end of this masterclass, you will know exactly how this matrix-level trap works. I'm going to give you the specific tax forms they use to lock you in and the exact step-by-step sequence you must take to break out of it. Make sense? So do me a massive favor. Put your phone on DND, close your other tabs. Pay close attention, because what you don't know about this system today will bankrupt your retirement tomorrow. Let me show you exactly how this systemic trap gets triggered in the real world. We're going to look at the anatomy of this absolute disaster through the eyes of a 73-year-old widow named Barbara. Back in 2024, Barbara did what literally millions of retirees do every single day. She downsized. She sold the massive family home she'd lived in for 30 years. The market was red hot, but did she make out okay? Oh yeah, she walked away with a very healthy $400,000 profit. Now, Barbara is a responsible adult. She even uses a professional CPA. She knew all about Internal Revenue Code Section 121. Sounds super complicated, right? It's really not. It just means that as a single filer, Uncle Sam allows her to exclude $250,000 of capital gains on her primary residence completely tax-free. So, $400,000 profit minus her $250,000 exemption leaves her with what? Exactly a $150,000 taxable capital gain. She wrote a check for her long-term capital gains tax in 2024, parked the rest of that sweet cash in her bank account, and slept like an absolute baby. She honestly thought she played perfectly by the rules. She thought the real estate transaction was a closed chapter, wiped entirely clean from her financial slate forever. But here is the terrifying reality about her situation. She was dead wrong. Because what Barbara didn't realize, and here's a massive red flag, what her highly paid CPA completely forgot to warn her about, was the invisible ripple effect. Sure, she beat the basic tax code, but at what cost? She just unknowingly detonated a massive ticking time bomb right inside her Medicare and Social Security profile. That $150,000 in taxable gain didn't just cost her a simple, one-time tax bill. It did something much worse. It artificially spiked a silent, absolutely deadly financial metric known to the IRS as her MAGI. That stands for Modified Adjusted Gross Income. Think of it as the government's all-access VIP pass straight to your retirement savings. And that artificially spiked MAG, I wasn't doing anything right away. It was just lying dormant in the system, lurking in the server banks like a financial Trojan horse, patiently waiting for the calendar to finally hit 2026. Fast forward to right now. 2026. The Social Security Administration's massive computer systems do their annual sweep. By law, under Title 18 of the Social Security Act, Your Medicare Part B and D premiums are dictated by your income, but they don't look at what you are making today. Oh no, that would make way too much sense for the government. They look exactly 2 years backwards in the rearview mirror to calculate your bill. When the SSA looked at Barbara's 2024 tax return, they didn't see a sweet 73-year-old widow living on a fixed income of 40 grand a year. What do you think the system actually saw instead? They saw a high net worth baller with a MAGI of $190,000, all because of that one innocent home sale. Boom. The first domino officially falls, and it absolutely crushes her monthly budget. Barbara gets shoved violently into the fourth tier of something called IRMAA. That stands for the Income-Related Monthly Adjustment Amount. It is essentially a brutal wealth tax cleverly disguised as a mandatory healthcare premium. And here is the truly savage truth about IRMAA. It operates on a ruthless cliff system. If your MAGI is even one single solitary dollar over their arbitrary threshold, you are fully penalized. No exceptions at all. You get hit with the maximum surcharge for that entire bracket. Overnight, Barbara's standard Medicare Part B premium of about $174 rockets to over $450 a month. Her Part D coverage gets slammed too. In total, the government simply decides to automatically deduct nearly $600 a month directly out of her Social Security check. Just snatched right out of her pocket before she even sees it. Barbara obviously panics. She just lost almost $7,000 of yearly fixed income. She goes online, desperately searching for a lifeline, and finds out about an appeal process. She downloads Form SSA 44, hoping to fix this mess. This is the official form to request a reduction in the IRMAA surcharge due to a life-changing event. She fills it out, pleading that she just sold a house to survive inflation. And guess what happens next? She gets instantly, categorically denied. Why? Because if you actually read the microscopic fine print of federal law, the SSA only recognizes 8 very specific life-changing events, things like marriage, divorce, or your spouse literally dying. A one-time capital gain from selling property is explicitly, intentionally excluded from that list. It's like the casino deliberately rigged the slot machine against you. The trap has snapped completely shut on her finances. The massive deduction is absolutely permanent for the entire calendar year. She's bleeding cash, and the system offers 0 appeals. But guys, let me be totally real with you. This is only the prologue to the nightmare. Here is where the absolute genius of the government's trap truly shines. And I use the word genius with heavy sarcasm. Let me show you how one totally innocent mistake forces you to make literal illegal ones. Barbara is suddenly short $600 a month. Groceries are insanely expensive. Inflation is eating her alive, and she still has to pay property taxes. So, to survive these now massive Medicare premiums, she does the only thing she can. She is forced to take emergency cash out of her retirement accounts. She logs into her brokerage app and withdraws $30,000 from her traditional IRA. But she's absolutely terrified of running out of liquid cash, right? So she tells the brokerage, "Do not withhold any taxes from this withdrawal. I need the full 30 grand in my checking account right now." And boom. Welcome to the devastating reality of domino number 2. By pulling that $30,000 from a tax-deferred account, Barbara just added 30 grand of ordinary income to her current tax year. And what exactly does that do to her already messed up financial profile? It inflates her MAGI all over again. This mathematically guarantees that when the government does its 2-year look back in 2028, she is going to get hit with the massive IRMAA penalty a second time. She has unknowingly trapped herself in a perpetual, never-ending loop of brutal Medicare surcharges. Wall Street financial planners literally call this the IRMAA Death Spiral. You're just bleeding cash year after year. But guess what? The system isn't even close to done bleeding her yet. Because she didn't withhold taxes on that $30,000 withdrawal, when tax season finally arrives, the IRS algorithms instantly flag her account. Red lights everywhere. She violated the strict pay-as-you-go tax rules. The IRS slaps her with Form 2210, the dreaded underpayment of estimated tax penalty. Now she owes the original tax on the 30 grand plus a brutal penalty fee plus interest. Talk about kicking someone when they are down. But the federal government has one more trick up its sleeve to deliver the final, absolute killing blow to her nest egg. Remember Barbara's exact age? Barbara is 73 years old. Under the new, highly aggressive rules of the Secure Act 2.0, age 73 is exactly when required minimum distributions, or RMDs, become strictly mandatory. You literally have to withdraw money. Because Barbara took that emergency $30,000 withdrawal completely haphazardly, just trying to survive the month, she didn't calculate her exact RMD formulas with a professional. As a result, she came up painfully short on her legally required distribution. And do you want to guess the penalty for missing a required distribution under the new Secure Act 2.0? It is a staggering, mind-blowing 25% excise tax on the exact amount she failed to withdraw. Let's recap this absolute train wreck. Because Barbara sold her house to downsize, her Medicare premiums tripled, her Social Security check was violently slashed, she was practically forced to drain her own IRA just to buy groceries. She guaranteed herself another IRMAA penalty in 2 years. She triggered a Form 221, IRS underpayment penalty, and she got hit with a 25% Secure Act penalty. We are looking at total, undeniable systemic collapse. Now take a breath. Unclench your jaw. If you or your parents are anywhere near this chaotic situation, I've got you covered. I am going to give you the exact master rescue plan to short-circuit this trap. The difference between utter financial ruin and absolute boss-level control of your wealth comes down to one single word: sequence. It's like defusing a bomb. You must execute these exact steps in the correct order. Step 1. Neutralize the IRS Form 2210 penalty instantly. If you've been backed into a corner, forced to pull money from your IRA to survive those insane IRMAA cuts, and you didn't pay estimated taxes, stop panicking. Do not wait until April to let your accountant figure it out. You must immediately go to the IRS website and download Form W4V. This is the voluntary withholding request form. Sounds boring, right? But wait, you are going to submit this piece of paper to the Social Security Administration. You'll ask them to withhold a flat percentage, either 12 or 22%, from whatever is left of your Social Security checks for the remainder of the year. Why would you willingly give them more money now? Because of a massive glitch in the matrix loophole in the U.S. tax code. The IRS treats tax withholding from Social Security as if it were paid evenly throughout the entire year. It doesn't matter if you submit the form in December. This effectively acts as a financial DeLorean, a literal time machine. It instantly wipes out your Form 2210 underpayment penalty for those emergency IRA withdrawals like it never happened. Boom. Problem 1 solved. Step 2. Break the IRMAA Death Spiral using a QCD. Look, you cannot invent a time machine to change the fact that you sold your house. That taxable event is locked in. But you absolutely can stop those panic IRA withdrawals from triggering another devastating IRMAA penalty 2 years from now. How? By completely changing the plumbing of how you withdraw your money from the system. Instead of taking cash directly into your checking account to satisfy those annoying Secure Act 2.0 RMDs, you are going to execute a Qualified Charitable Distribution, or QCD. This is a massive cheat code for high net worth individuals. The law legally allows you to transfer up to $105,000 directly from your IRA to a qualified charity. Here is the absolute magic of the QCD. It legally satisfies your required minimum distribution for the year. This totally saves you from that brutal 25% excise tax penalty. But, and listen to me, this is the most critical part of this entire video, that money does not show up on your tax return as income. It ghosts the IRS. It bypasses your MAGI entirely. By doing this Jedi mind trick, you instantly drop your income bracket, literally starving the IRMAA algorithm of the data it needs to penalize you. This perfectly guarantees your Medicare premiums will drop right back down to the baseline minimum in the very next cycle. The death spiral is officially broken. You are back in the driver's seat, but we're not done. Step 3. The Roth conversion timing. This is for the proactive players. If you are planning to sell a primary residence or cash out a massive stock portfolio, do not wait until you are 71 or 72. You must execute Roth IRA conversions aggressively in your 60s. Yes, you are deliberately taking the tax hit early. You bite the bullet now, so that by the time you reach age 73, you are bulletproof. Because when you fall under the Secure Act 2.0 RMD rules at 73, your traditional IRA balances are completely zeroed out. Think about the math here. No traditional IRA balances means absolutely no required minimum distributions. No RMDs means no forced income on paper. No forced income means no MAGI spikes. And no MAGI spikes means you keep 100% of your Social Security checks safe from the government's greedy little hands. Look, they don't teach this stuff in high school, and honestly, half the professional CPAs out there won't even warn you about it. Why? Because IRMAA isn't technically classified as a tax, it's merely a premium adjustment. They hide behind boring legal semantics to literally drain your life savings. Let me be real with you. The financial system in this country is not broken. It is functioning exactly, flawlessly, as it was designed to. It is a ruthless machine built to catch the uninformed, penalize the innocent, and extract maximum wealth from those who simply don't understand the rules of the game. Barbara didn't do anything maliciously. She just wanted a smaller house for her final years. And the system almost swallowed her whole. Do not let this happen to you. And absolutely, positively, do not let this happen to your parents. I want you to copy the link to this video right now. Text it to anyone you know over the age of 60. You could literally be saving them hundreds of thousands of dollars. You'll save them unimaginable stress in their final decades. If this masterclass opened your eyes, hit the like button so the algorithm pushes it to more people who desperately need to hear the truth. Subscribe to the channel and turn on the notification bell, because I will keep tearing apart these systemic traps one piece of legislation at a time. Until next time, stay vigilant, protect your assets, and don't let them take a single dime more than they are owed. I'll see you in the next one.